the volatility of private equity turns out to be much closer to public stocks than the raw numbers suggest. A buyout fund's real volatility was around 50% per year after adjustments versus just 10% based on the reported returns. And for venture capital, it jumps from 12% to 23%. That's a big difference, and it matters a lot for deciding how much of your portfolio to put into private equity. Hey, welcome back. Today we're getting into something that used to be reserved exclusively for billionaires, pension funds, university endowments. It's the concept of private equity as part of your investment portfolio. And I know some of you might be thinking, okay, that's not for me. But stick around because that's actually changing. It has changed. And there's some really important things that you should know as a retail investor before you decide whether it belongs to your portfolio at all. Because every portfolio managers on the streets and advisor right now are pitching private equity, private credit, private real estate as an investment solution in order to differentiate themselves and help you chase higher returns, lower volatility, or a combination of both. So this episode is based on a brand new research paper published in March by Vanguard, one of the biggest investment firms in the world. The paper is called Right Sizing Private Equity in Your Portfolio. It depends on more than you think. And the subtitle says everything, because when people most hear about private equity, they either run away from it thinking that it's too risky or too complicated, or they run towards it because they're chasing big returns. The truth, as usual, is somewhere in between. So today we're going to break it down in plain English. What is private equity? What are the potential upsides? What are the real risks? And I mean the ones that are often overlooked or glossed over. And ultimately, how much of your portfolio, if any, should be in private equity. So by the end of this episode, you'll have a clear framework for thinking through that question for your own situation. Let's get into it. All right, let's start with the basics. What is private equity? When you go to your brokerage app, Wealthsimple, Questrade, and you want to buy shares of Apple, Amazon in seconds, that's public equity. Companies that are listed on a public stock exchange where prices update in real time and anyone can buy and sell whenever markets are open. Private equity is the opposite of that. You're investing in companies that are not listed on a public exchange. They're privately owned, startups, mid-sized businesses, or larger companies that have been taken off the public market by private equity firms. And here's the thing, the market has gotten enormous. Vanguard's research points out that private equity made up just 1% of the total equity market, the global equity market back in 2000s. But by 2024, that has grown to 8%. The number of US companies backed by private equity grew more than fivefold over the same period, from about 2,000 companies to 11,000 companies. That's a massive slice of the business world that you simply cannot access through your regular stock app or brokerage account or index funds. Now, let's look at the ways regular investors can access private equity. And there are two different structures that you should be aware of. The first one is called drawdown funds, and sometimes they're also called closed-end funds. Think of it like this. You commit a pile of money up front. You commit. You don't necessarily give it right away, but you commit it. And then over the years, the fund manager, private equity fund manager, will gradually call that money from you as they find deals and companies to buy. So you don't just hand it all over on day one. So you need to manage your capital calls, that is called over time, to match and make sure you have enough liquidity at the time that that money is going to be called. And on the other hand, you don't get your money back until the manager sells the companies in the fund. And that can take multi-years, decades or more. So they're typically only available to very wealthy individuals or institutional investors. I had the opportunity to work for a billionaire in a family office for a short period of time in 2022, and I got exposed to this investment strategy. How do they commit capitals? How do they plan to commit capitals over multi-decades? And how this whole structure worked. And it was very interesting to see the level of commitment and also all the risks that were involved. And this is where most retail investors get this wrong. But when you're a billionaire and you have a family office, this approach can technically make sense based on their goals and time horizon. Okay, now the second type of fund that you should be aware of, which is more accessible to retail investors and it has gained a lot of popularity, it's called the semi-liquid fund or the evergreen fund. These are more like a traditional mutual fund in a way that you can buy in monthly and you have the ability to sell, although that's more limited than a public stock. You can just sell every day. They're not fully liquid, but they're a lot more flexible than the drawdown funds. And they often have lower minimum investments, which is why part of your retail investors are starting to get access to them. Okay, so now that we talked about the what is private equity, let's talk about the why. Why would you want to invest in private equity in the first place? There are three main arguments for adding private equity to your equity portfolio or to your portfolio. So let's go through each of them. The reason number one is the potential for higher returns. The big draw of private equity is the promise of better returns than the public stock market. And there is a logical reason for this, and it's called the liquidity risk premium. Basically, because you're locking money up for a long time and you can't easily sell, you should expect to be compensated for that inconvenience with higher returns. Think of it like a savings account that locks your money in for 5 years versus one you can access anytime. The one that locks your money for 5 years should pay way more interest than if you just can access it at any point in time. So Vanguard cites research suggesting this liquidity premium could be around 3 percentage points per year. That can be significant when you compound this over time. Reason number two is you have access to companies that you can't find on the stock market. Remember what I mentioned that over 11,000 companies are backed by private equity? You simply cannot buy these through your brokerage account. So private equity gives you access to an entirely different corner of the economy. Often you have earlier stage companies, you have faster growing companies. And the third argument to add private equity to your portfolio is because of this concept of diversification. In theory, because private equity doesn't move in perfect lockstep with the public stock market, having some of your portfolio in private equity can smooth things out a bit. Vanguard's data does confirm there's some diversification benefit, though they're very careful to point out that it's very modest. And there's an important asterisk here, and we'll go into it in a second. Now, before you run off to find a private equity fund, I want to be upfront. Vanguard says that their research that these are potential benefits. Whether you actually capture them depends enormously on your specific situation. And that's exactly what we're going to dig into next. And this is the part where most people skip and they glossed over in a lot of private equity marketing. So let's talk about the real risk of private equity. The risk number one is the illiquidity premium. Your money is locked up. This is a big one. When you buy a stock in a public company, you can sell it tomorrow or in 5 minutes if you want to. With a drawdown private equity fund, you're typically committed for 10 to 12 years. And if something happens, a medical emergency, a life change, you just need money. Think of if you're in retirement and you're relying on income, your options are very limited. You can try to sell your stake or what's called a secondary market, but you're likely to have to accept a significant discount to what's actually worth. We're not talking a small haircut here. We're talking about materially less money. And even the semi-liquid fund that I mentioned, the evergreen fund, they are, yes, more accessible, but they're not truly liquid. You might be able to redeem quarterly, but only to a certain cap. If lots of investors want out at the same time, you might not be able to sell all your shares. So when you see semi-liquid, don't think liquid. And we're seeing this in private credit right now. There's massive redemptions in Canada and the US, which I'll make subsequent video on this. But there's investors are being capped or reaching caps and are being locked. There's about 40% of the private real estate market in Canada that is currently locked up. So this is a real risk that investors are seeing. And I don't think they're necessarily aware of what it actually means. The risk number two is that valuations are not like stock prices. Here's something that surprises a lot of people. Unlike public stocks, where prices update constantly based on real market transactions, private equity valuations are typically done through internal appraisals. Basically, the fund says what they think the investments are worth, rather than having the market determine it in real time. Now, why does this matter? Because it makes private equity look more stable than it actually is. Vanguard adjusts for this in their research, and when they do, the volatility of a private equity turns out to be much closer to public stocks than the raw numbers suggest. A buyout funds, which is a type of private equity strategy. A buyout fund's real volatility was around 50% per year after adjustments versus just 10% based on the reported returns. And for venture capital, it jumps from 12% to 23%. That's a big difference, and it matters a lot for deciding how much of your portfolio to put into private equity. This is a really important risk to be aware of, being reported as being a much lower volatility than the public stock market. But when you actually adjust, you actually end up with a volatility that is very much understated. And that's where most investors get wrong. And that's where most marketing materials don't mention. Risk number 3 is the manager selection. This is huge because in the public stock market, you can just buy an index fund. You can get the Vanguard Solutions one decision portfolios for about 20 something basis points. You can access factor based funds through us for about 29 basis points. And then, of course, there's the advisor fee there on top of that. But this is the type of low cost index solutions that you can have access to as investors. But in the private market, you don't have that yet. So in private equity, there's no equivalent to that. You have to pick a manager. And this is where things get really interesting and also very scary. Because Vanguard's data shows that the gap between a good private equity fund and a bad one is enormous. The difference between the 70th percentile buyout fund and the 25th percentile buyout fund is more than 4 times larger than the equivalent equity gap in public equity funds. And for venture capital funds, it's 5 times larger. So choosing the wrong manager doesn't just mean slightly underperforming. It means that you can dramatically underperform. And this is why it's a really big problem, because when you look at the research, the past performance in private equity doesn't reliably predict future performance. We see that in public equity as well. The data is very straightforward there. If you look at past returns of mutual fund managers that are investing in public equities and public fixed income, there's no correlation with future expected returns. And we're seeing the same thing in private equity fund managers as well. So now, if you're picking a private fund manager and you're picking the wrong one, it can become extremely costly. And there's no real strategy that will allow you to pick the right one in hindsight. Because if you do look at their past returns, it's not reliably predicting what the future returns will be. So you can't just look at who did well in the past and assume that they'll do well again. The fourth risk that you should be aware of are the fees. Private equity is expensive. Vanguard's research shows that fees on drawdown funds typically run between 100 basis points to 400 basis points per year. That's 1 to 4%. And that's the all-in cost estimate. Compare that to public equity active mutual funds, which might run between 50 basis points to 200 basis points, and low-cost mutual funds, which I just mentioned, are anywhere from 20 to 30 basis points. And both of those are far more expensive than, of course, your simple index funds, which I just mentioned, which can just cost a few basis points. Fees are one of the biggest drags on long-term returns. So this is really matters. And people are realizing that you should be aware of the fees. The cheapest solution might not be the best, but the most expensive solution is rarely the best. And there's no correlation between a fund that is costing a lot higher versus the returns that you can expect from them, which is counterintuitive because in everything else in life, if you pay more, you should expect to get more. But in investing, it doesn't work that way. All right, so we've covered the case for private equity. We've covered the risks. Now the big question, how much of your portfolio, if any, should go into private equity? So Vanguard's answer is, it depends, which I know sounds like a non-answer, but their research actually gives us a really useful framework. Their model found that depending on your situation, the right allocation to private equity could be anywhere from 0% to 40% of your total equity allocation. Of course, that's a wide range, but it's intentional because the right number really is different for different people. So let me walk you through what moves that number up or down. The first factor that you should consider is your time horizon. If you need money in 5 years, private equity is probably not for you. If you have the 20-year investment horizon, say you're in your 30s or 40s, you're saving for retirement, the illiquidity premium becomes a lot more manageable. So private equity rewards patience. I would also argue that public equities also rewards patience. If you look at the wealth of Warren Buffett, for example, and one of the best investment managers, most of their wealth came from compounding, not necessarily stock picking in the later stage in life. It's just time in the market beats timing the market. The second factor is your ability to pick or access a good manager. I just talked about how important manager selection is. Picking the right manager is extremely important versus picking a bad manager. If you have access to top tier private equity managers, and this is often restricted to large institutions and very wealthy investors, that's a meaningful advantage. When I was at the family office, because they were billionaires, of course, they have access to top tier fund managers. But for you, the retail investor and your advisor, they rarely have access to top tier managers. They have access to lower tier managers. And those have a much higher probability of underperforming given their budget, their strategy, their staff. And even the best managers have a hard time to deliver outstanding returns. So the bad managers have a much even harder time to actually deliver the returns to justify the fees that you're paying them. But if you're using a semi-liquid fund through your financial advisor, the key question is, how good is that fund's management team? Really? Vanguard's found that the expected alpha, that the extra return above the benchmark, was one of the most sensitive inputs in determining the right allocation. So lower expected alpha means lower allocation. The third factor determining your allocation is your tolerance for illiquidity and active risk. So let's define this. Vanguard modeled this directly. An investor with zero tolerance for liquidity risk, then you have 0% allocation to private equity. It just doesn't make sense for you if you cannot lock your money away. So an investor with a high tolerance for active risk, meaning that they're comfortable with the uncertainty of manager performance, then you might allocate up to 40% of their equity allocation. And someone with lower active risk tolerance might be at 22% or lower. This model is very sensitive to these preferences. An active risk is how much you will differ from the benchmark. One of the most striking findings in the paper is what happens when investors ignore these risks. What Vanguard calls being fully naive. An investor who doesn't account for the true volatility of private equity, doesn't factor in liquidity risk, and doesn't consider active risk might think, that looks amazing. I should put 100% of my equity allocation into private equity. That's obviously wrong, but it shows why understanding these hidden risks is so important. Now, the fourth factor you should consider before allocating to private equity is that diversification across managers and style matters a lot. Finally, don't put all your eggs in one private equity basket. Vanguard found that focusing only on venture capital funds, even with skill manager selection, reduced the appropriate allocation significantly compared to a diversified mix of buyout and venture capital funds. So diversification within private equity matters because it's going to allow you to hedge your bets. And we just mentioned that manager selection is extremely important. Diversifying your bets, you should reduce your risk of putting all your money with a bad manager. And hopefully within your selections, you'll have at least one good manager that will ultimately offset the lower performance from the bad managers. Again, extremely sensitive to manager selection. And this whole game is coming down to this ability to picking the right manager at the right time, and hopefully that they will deliver on their promise. All right, so let's bring it together. Here are the takeaways from today's episode. Number one, private equity has grown significantly and is becoming more accessible to everyday investors. But accessibility doesn't mean it's right for everyone. Number two, the potential benefits are real. Higher returns via a liquidity premium, access to a wider range of companies, and some diversification. But those benefits come with real costs: liquidity, opaque valuations, high manager risk, and significant fees. Number three, don't be fooled by how stable private equity looks on paper. The reported valuations understate the true volatility. When you adjust for that, private equity is actually about as volatile as the public stock market. Number four, manager selection is everything, and it's really hard to get it right. Past performance doesn't reliably predict future results. And number five, the right allocation for you could be anywhere from 0 to 40% of your equity portfolio, but it should be based on your time horizon, your liquidity needs, your tolerance for uncertainty, and your honest assessment of what managers you can access. If you can access the best managers in the world and you're extremely wealthy, sure, you have a much higher probability of benefiting from allocating to that asset class. But if you don't have that much to invest and you're investing with your retail investment advisor, you have a much lower probability of having a good experience by investing in private equity because their access is very limited compared to the billionaires and the institutions. Private equity can be a powerful tool, but like any powerful tool, it needs to be used carefully and in the right hands. Don't chase higher returns just for chasing higher returns. Make sure you understand what is your required rate of return that you need to achieve to meet all your goals. This is the starting point. And this is how I work with clients who are incorporated in Canada, whether you're a professional or you own your business. Let's model a specific plan for you and then right size your investment portfolios with the right asset classes to make sure that you have the highest probability of meeting your goals. Thank you so much for listening today. If you found this useful, share it with someone who's been wondering whether private equity is right for them. And as always, invest wisely, stay curious, and I'll see you on the next one.